Agarwal's Healthcare is on your radar.
So first one is Adani Green. Yesterday we saw JP Morgan moving two of its RG bonds. RG is basically restricted group bonds to overweight from neutral. And today Macquarie has come out with a note on Adani Green, initiating coverage with an outperform call, and target is 1200 per share, implying an upside of almost 40% from current levels. It says it's leading India's energy transition, and targeted capacity by FY30 is almost more than 4x from current levels. It's targeting 50 gigawatt capacity by FY30 versus 12 gigawatt capacity now, and conservative pathway implies 25% EBITDA CAGR over next 5 years. It expects company to generate $1.8 billion annual operating cash flow, and despite the high capex that company has, Macquarie believes that net debt to EBITDA will decline to 5x by FY30 versus 7x now. Second one is Dr. Agarwal's Health. Morgan Stanley has initiated coverage with overweight call, and here target is 502, implying an upside of more than 15%. It says eye care industry is high TAM. TAM is total addressable market. Second, high barriers to entry and high returns as it is asset-light model. It believes that company is well positioned to outperform, and revenue at 1.7 times. Revenue is 1.7 times closest to its PR.
Sudarshan, okay, BEL's gone, Sudarshan. Sorry to rush you. But we've got a positive opening, 50 points higher on the Nifty. The mid-cap index is looking even better with a gain of about 200 points right now. Bank Nifty is up about 0.25%. So banks are leading the charge on the way up for the index. Let's look at what's moving. BEL, 2% higher. BEL's order flow has been very, very smart. They've been announcing orders on almost on a daily basis. Market likes that, 2.5% up. IndusInd Bank is seeing some more recovery, 2% higher. ONGC, Tata Steel, Bajaj Finserv, these are some of the names on the upside early on. Now it's about a 35-point gain on the index. Tech is recovering after yesterday's drubbing. So Tech Mahindra, Infosys, these are some stocks that are seeing some early green. TCS is at the flat line, not quite a gain, but just a couple of notches here and there. Then there is some buying that we're seeing in names like Bajaj Finserv, but now it's also a little red. So let's look at the red side. Dr. Reddy is lower, Ultratech Cement is down, a couple of FMCG names like Britannia, Lever starting lower, Titan is starting lower, Trent is starting 0.25% lower as well. Kotak Mahindra Bank is slightly soft. The market's turning. Actually, look at the mid-cap index. It's suddenly showing a shade of red. Quick, swift turn. Nifty is still trying to hold on to a 30-point gain. It's a volatile start, to say safely.
I think par for the course, right? You get mild green, it gets into the red. That's par for the course on the headline index. The breadth of the market is good. You still have 1,400 stocks that are advancing for 500 stocks that are declining, so I like that. A couple of names in the broader markets that are moving higher on high volumes. MTNL stocks up close to on 10%, massive volumes on that one. SCPC, they won a big order yesterday. The stock was up close to on 20%. It's up close to around 4% yet again. EIL, that's up close to around 2.5%. So good move is what we're seeing on that particular name. Very, very large volumes as well. BEL won another order. Street likes it. Adani Green, Sudarshan quickly told us about, brokerage update out there that brokerages are fairly positive on the stock, and there's an initiating coverage report as well. So that opens with a gain of around 1.5%, but it already had rallied close to 4% in yesterday's trade. Tata Steel, JP Morgan likes it. The street likes it as well. That stock is up and about in today's trading session. As we speak, the mid-cap index is trading more or less flattish, mildly in the red. The Nifty Bank, though, up close to around 75 points. Fairly decent start.
On MTNL, I just want to point out that yesterday there was a reply in Parliament that BSNL and MTNL, they've been selling off their assets, including land, and together both the entities have gotten about 13,000 crores. So that's something the market seems to like.
Well, this has been the long dream, right, for MTNL. The only question is that of this 13,000 crores, how much comes to the shareholders in form of any sort of dividend or special bonus, or if at all that money does come by or not. Meanwhile, a bunch of stocks which are now picking pace. We have Emphasis, which is now moved to the high point of trade. Avenue Supermarts is starting out well as well. And Balrampur Chini, all of yesterday we were wondering why is it that the stock's moving higher, and now the stock's open lower, so maybe some profit booking on that one as well. And Gensol is another stock that I'll keep an eye out on. Down 18% this week, lower circuit right now as well. And today is 13th, which implies that they have that meeting to consider fundraising. So we'll keep an eye out on Gensol out here as well. Carousel, which was up 20% yesterday, seeing some bit of profit taking in today's trading session. A couple of these textile names are buzzing right now. Nitin Spinners, for instance, is up around 3% and moving with a fair amount of volumes as well. Varun Beverages, too, as we move into summer months, maybe some bit of demand expected out there, demand improvement expected out there. That stock up around 1.5%. But good time to welcome in Nilesh Shah, who's the Managing Director and CEO at Envision Capital, joining us now. Nilesh, Good morning. Good to see you in. We've seen a drubbing in the markets. We've seen some recovery. Now things look like they're more or less settled, if not, running away still. Though what's not settled is what's taking place in the US. Let's start with the IT. Everyone's been super bearish on IT right now. We've got a couple of brokerage cuts that came by too. And right now, over the overnight when we saw that positivity come back in NASDAQ, that's reflecting in some of our IT stocks. But all said and done, where do you stand?
So, Mangalam, good to be here on the show with you, and good morning to all the viewers. In the very short term, we are going to be correlated with the NASDAQ and the US markets as far as the big IT companies go. But the bigger challenge which IT companies have been facing now for many years is basically a very tepid kind of growth. The growth is pegged to the US GDP, which probably grows at around 2 to 3%, and versus that, they have been growing at about 4 to 5% in dollar terms, and at best, maybe high single-digit growth in terms of the rupee or the local currency. So I think from a growth point of view, there's really no juice in the large cap IT names, the top tier names. Clearly, I think it's more a kind of a PE or a multiple arbitrage that you play in, with about 20 times being the floor and about 30 times being the ceiling. So clearly, I think currently the large cap names are trading currently at 23, 24 times trailing earnings. Probably, I would still think there's a bit of a downside to the large cap IT names. However, having said that, clearly the big opportunity is in the tier 2, tier 3 IT companies. Clearly believe that those companies which will work on developing their own agentic AI solutions will be the big winner for the medium to long term. And I think that's an opportunity which can give them strong double-digit kind of growth over many years. So clearly that's the space to be focused on. Second is there are a few tier 2 companies which are product companies, enterprise software companies, which have corrected quite meaningfully over the last 2 months. They've corrected probably between 30 to 40%. And valuations have become way more reasonable, and they deserve to trade at a premium to the market or a premium to the large cap IT company. So I clearly believe that's really where the focus of investors should be, and not necessarily basically focus on the top 3 or top 4 companies.
Okay, all right. Hi, Nilesh. Good morning, and always good to see you. Nilesh, first on the market, it's a correction, or are we getting into bear territory? What's your take on the Indian markets?
Well, I would be in the correction camp. I clearly believe there are no strong reasons for India market to be in a bear zone. Corrections of close to about 15 to 20% are pretty much par for the course. Even in a bull market in the past, we have clearly seen markets correct by 15, 20% and then kind of basically rally. I think in the past, whenever these kind of corrections have happened, at that point of time, investors looked upon that as kind of a risk, the way they currently see the current correction, but clearly in hindsight, that becomes an opportunity. I probably think that maybe a few quarters down the line, when we look back, we would think that, wow, what a correction that was, and what an opportunity that presented.
Well, that's right. If hindsight was foresight, we'll all be millionaires, right? But, a lot of investors out there who haven't seen, 15, 20% pullback, they're getting very, very jittery. In fact, it was heartening to see that the SIP book is still intact at around 26,000 crores or thereabouts. So some maturity from investors is definitely, being seen out there. Let's talk about this large versus small cap debate, right? The small caps, the mid caps, they've got hammered, but they had a big, big party. Do you think pockets are still emerging now where we are seeing some kind of pockets of strength? As you said, I think from the IT pack as well, there is the mid caps that will grow at a faster clip. So for the market construct itself, if you're allocating money, what would it be as of now? Large, mid, small?
I would still think from a medium to long-term perspective, it still has to be the mid and the small cap. The mid and small cap companies are growing at a faster pace versus their large cap peers. They're becoming more capital efficient. The access to markets, their access to capital has kind of improved quite significantly over the last few years, which clearly puts them in a very vantage position. Given their relatively smaller size and being very strong in several niches, gives them basically a strong tailwind of growth. So clearly, the space to be in for medium to long term is the mid and the small cap kind of space. The large caps have been struggling with growth. I mean, whether you look at large cap IT companies, large cap FMCG companies, large cap banks, They have been growing below industry growth. They are the guys who are getting challenged by the challengers, and therefore are essentially kind of have been reporting very tepid growth. So my view is, instead of, why look at large cap? They can probably give you high single-digit return. Might as well then be in fixed income rather than, because you have the downside of equity and probably just at best the upside of fixed income.
Nilesh, hi, morning. Great to have you on, and holy greetings to you. This is exactly the point that I was discussing and debating yesterday, because our colleague Rima, she put up a chart on forward earnings projections for IT companies FY26. The numbers were like 3%, 3.5%, 4%, 4.5%. So I was joking, saying you replace all the IT names and put in the FMCG names. It'll be the same chart. It's the numbers haven't changed. And that's the problem with the market, exactly what you're saying, that the large cap side of the market, there's no growth. So then what are you paying for? Anyway, so that's a separate debate. But I want to spend some more time on IT. You've always liked the digital themes a lot. It's not in this correction. You've been liking them for last, I think, a year and a half or 2 years. In this correction, Nykaa, Paytm, Zomato, Swiggy, PB Fintech, these stocks are down between 30% to, I just checked, 44% on Swiggy. Swiggy is way below its, listing day price as well. With this kind of a value destruction, do you see bargains? And more importantly, do you see some growth safety as well? Because a lot of these companies are still in investment phase. For instance, the quick commerce guys are setting up these dark stores. And they've acknowledged that it will pressurize margins, at least in the near term. So what to buy in digital after this market fall?
So we invest, we are holders of probably most of the names that you basically mentioned. So that's the disclaimer here. But clearly, this is honestly an opportunity for many, many years. Digital essentially is the way forward. And clearly believe that over the next 3 to 5 years, the digital platform companies will keep compounding in double-digit rates. They'll become significantly larger, and many of them, one odd name has made it to the Sensex and the Nifty. But I probably think that the composition of the Sensex and the Nifty itself will change over the next 5 to 7 years with many more additions to their names. While each one of them does have competitive intensity or regulatory challenges here and there. But today, look at it. What are the two big risks that this market is facing? One is on the tariff front. Second is on dollar devaluation. On both those risks, digital platforms score high. They remain relatively insulated from both these risks, and the entire growth opportunity is the domestic space, where they have the opportunity to go ahead and keep garnering market share and keep growing at double-digit rates. So I clearly believe that this correction that we have seen of about 30 to 45% in digital platforms or digital companies clearly is not just great from a risk point of view, but is also great from a growth point of view.
Okay, so that's one space you're absolutely convinced about. Before we let you go, any other ideas, solid ideas, where now you're getting a great price entry point and you're seeing reasonable growth ahead? What else, apart from the digital companies?
So apart from the digital companies, I think the consumer product companies, and I'm not talking of the large cap FMCG companies, but maybe again the smaller consumer product companies which have strong, basically niches. I also believe that over the next few years, consumption will remain relatively resilient, especially with the initiatives in the most recent budget, and then some of the other direct benefit transfers which state governments are doing to consumers. I think a combination of all of that will leave more spending power with consumers, and a couple of categories which I think will remain standout categories will be the alcobev space, and second is essentially the beauty and personal care segment. So I clearly believe consumer products as a category looks good. Within that, subcategories like alcobev or beauty and personal care could end up being standout categories.
Just quickly on PB Fintech, you own that stock, specifically just asking because of the diversification that they've done. They've deployed capital in PB Healthcare. The street did not like this diversification away from core.
Well, Mangalam, they have been, of course, this is essentially a development which is 6 months old. I think the management has gone on multiple occasions to clarify that the allocation will be no more than $100 million. I think the current allocation pretty much is within that ceiling of $100 million. I also see many other players in this space, hospital companies moving into insurance companies. Here is an insurance distribution company trying to kind of get into healthcare to improve the consumer experience. So I clearly believe that it's honestly not a very material kind of event. Unfortunately, the market sentiment is not really the best right now, and therefore these are probably being looked upon as markets as being some bit of a distraction kind of thing. But I honestly don't think this poses any kind of a structural headwind to their medium to long-term growth plans. And I don't see that as an issue of any serious capital misallocation.
All right, Nilesh, thank you so much for joining in and giving us perspective on a whole lot of things, including specific stocks as well. Wish you a very, very happy Holi and season's greetings as well, you and your team.
Thank you so much. Thank you.
Let's move on. Let's talk about Aster DM Healthcare. The stock is in focus. The promoters have cut their share pledge from 99% to 41% upon completion of refinancing of the debt. What does this mean for the company? What are the growth prospects looking like? All of that we discuss. Alicia Mupin, who's the Deputy Managing Director at Aster DM Healthcare, joins us now. Good morning, Alicia. Wish you a very happy Holi. Just a word on the pledge itself. It's down from 99% to 41%. The obvious question, when does it reduce further? What's the plan for that? And secondly, what is the debt on your books right now? You've refinanced a lot of the promoter debt. What's your cost of finance?
Good morning. Happy Holi to you too. So we're really happy actually, Mangalam, that we have managed to sort of reduce the pledge significantly. Of course, like you said, it's gone down from 99% to 41%. This was kind of needed at the time of the GCC transaction when we were selling, and it was just a bridge loan that required us to sort of take a large pledge. And because of technical reasons, even though we had kind of repaid a big part of the loan at that point, we could not reduce the pledge. So this refinancing with JP Morgan, HSBC, Barclays has actually allowed us to sort of significantly change the financial encumbrance, the LTV, all of that. So feeling, much better position for the family and for the company as well as we look forward to the future. And of course, as you're aware, there's a big growth prospect.
Right. But we understand that, but that still doesn't answer our question. What happens to the remaining 41%? When does that get depledged? And the refinancing, I mean, what rate it has been done at? What is the promoter's leverage right now?
Yeah, so the refinancing is being done at a very similar sort of 6% plus SOFR and stuff. So it's very competitive to what it was earlier. I think the bigger question that you're asking us, when does it reduce further, right? So we do believe that the merger is actually going to be a big part of us over the course of the next 1 year, further reducing it. So I think it kind of goes a bit hand in hand. So the goal is to reduce it significantly over the course of the next 12 to 24 months.
Alicia, just to kind of close in on that point in terms of promoter ownership and pledging, can you tell us if promoters are comfortable with their current shareholdings? Would you look to add to it? Or at any point in time, is there still that plan of gradually letting go of a little bit of the company?
No, so to be honest, we never kind of reduce our shareholding in terms of stake sale. It's been more reduction of shareholding because of the expansion that has happened.
The merger.
The merger, exactly. Yeah. So we are very positive and confident about sort of the growth prospects for Aster. So we don't think that, we don't have any plans, to be honest, of disposing of any or reducing our shares any further.
Okay, all right. Hi, Alicia. Good to see you in, and thanks a lot for joining in here on CNBC-TV18. Let's get two aspects out of the way. One is with regard to the merger. As of now, you're doing margins in that vicinity of around 19%. But you have plans that are going to take it up, I think, to closer to mid-20s. So what are the triggers in place for that? Point number one. And also point number two, your average revenue per bed, that's been nicely moving up. Where do you see that number stabilizing at?
Yeah, so the margin, like you said, actually, so the margin expansion, we are expecting this to be in the mid-20s. We think the revenue growth over the next medium term, 2-3 years, we will see it growing in the late teens. When it comes to the margin expansion, definitely we believe that the synergies with the merger will also help us kind of improve the margin further with the consolidation happening. So quite confident that we should be able to get to a 20-25% over a medium term, 3 to 5 years. On the RPOP, I think now there has been like a good CAGR growth of around 7 to 9% that we've seen in the last few years. And again, a combination of sort of the clinical work we're doing, right? I mean, if you just look at the sort of the number of transplants that we do 50 transplants a month. We do 500 robotic surgeries every quarter. So definitely there's RPOP growth that comes from that as well. So we see, assuming sort of a 7 to 8% RPOP growth to also come in, which we believe is comfortable considering the regions that we operate in.
Okay, to close the loop on the merger, by when does this merger take shape and the synergy benefits start flowing in?
I think we're still sort of talking about the merger to conclude in sort of by the end of this year or next the beginning of next year, right? So I think Q4 probably is a likelihood, and that's when I think we'll start seeing sort of the benefits slowly trickle in by early FY26.
All right, benefits come in from early FY26, 7 to 8% average revenue per occupied bed growth, late teens sort of revenue growth that you're anticipating, along with margins at around mid-20s as well. That's about, business as it is right now. Just a couple of things that are taking place. In Kerala, there's one big competitor which is entering with around 3,000 beds in the next few years or so. In the western part of the country as well, we had Adani's announced that they might, look at entering this space with a big hospital too. So on competition, what's your view? I mean, do you think there is enough space for everyone to sustain growth at the pace at which they are growing right now with the margins? Or may you, look at some sort of consolidation as well? What if the Adanis write a good enough check? Would Aster DM be willing to sell some of their hospitals?
We honestly think competition is always good. It just sort of improves the kind of the entire industry, and the demand supply requirements across the country is still significant, right? So in Kerala, definitely we have a clear market leadership, and even with the merger, the consolidation that happens in Trivandrum for us with the KIMS asset will just make us clearly number one by miles. So definitely competition will just help kind of further improve and attract better talent. So we're not really worried. In terms of Adani's getting in and others, we do think that, this is how the market has been. We've been operating now in Bangalore for the last 10 years. Every player is there. It just makes the market even better, to be honest, in terms of outcomes, in terms of margins, everything.
But if there are opportunities, are y'all on the, are y'all of the belief that maybe y'all can exit if the price is good enough?
No.
Not Adani's, but just generally.
Yeah, no, not at all. I mean, as a family, we're fully committed to sort of staying here for the long term. No, absolutely not. But always looking at strategic, options to sort of strengthen the company, right? And that's what we did with the demerger and now with the merger with QCIL as well.
All right, final question before we let you go. We have had Dr. Mopin as well joining in here in the studio and giving us his vision as well. Could you tell us currently what is the total capacity that you have in terms of beds, and you have a addition plan? So say in the next 3 years or so, what should the company's bed capacity look like?
So we are, as Aster, close to 5,000 beds right now, and we've got sort of a capacity expansion of another 2,000, 2,500 beds that's in the pipeline. And to be honest, the QCIL capacity is also very similar. So what we are seeing in the next 3 to 4 years is a 14,000 bed capacity that will be seen once and when the merger goes through. So we do have a very significant size, right? So I think integrating these platforms is going to be the most exciting thing for us, and I think that's what will unlock a lot of value for the shareholders as well as for our patient and customers as well.
All right, Alicia, we'll leave it on that note. Thank you very much for joining in, and good luck with all of those plans and all the expansion that you have lined up as well. Thank you for joining in. We do have to take a very quick break. Market's absolutely flat. Mid-cap index is down about 0.3%. We come back full throttle after this break and talk about the entire IndusInd Bank issue and the larger questions that it's throwing up with respect to accounting for derivatives, and what are the lessons for shareholders, and more importantly, can confidence come back? Karan Gupta of India Ratings and Abhizir Divanji of Neostrat Advisors join in. Welcome back. So it's, around the flat line, largely for the indices. Let's quickly pull them up, Nifty as well as the mid-cap index. That's the kind of morning. Quiet as she goes. That's what's going on. But we have that sort of larger issue to discuss. Like I said, it's all about IndusInd Bank. The stock, of course, saw some recovery yesterday. There was some buying early in the morning as well. Yeah, it's still up about 1% or so. But questions still remain after what was a massive 27% drop. And I think, a wipeout on that day for almost 20,000 crores in market cap. And all because the bank disclosed discrepancies in its derivative portfolio. Now, the bank's management obviously told us that this is a one-off instance and they're sort of very, very clear on disclosures and corporate governance norms. But we also understand, actually, from our colleagues in Money Control, that perhaps this is something that will get the RBI to open up a much wider review, should I use the term. Yeah, we've got those graphics up. That's what Money Control is reporting, that the RBI is now opening up a wider review of all other banks, private as well as PSU, to look at how banks are, looking at their derivative accounting, their trading books, and if there are any other discrepancies anywhere else. Let's talk about this. Karan Gupta, Director and Head of Financial Institutions at India Ratings, is joining in. And we also have Abhizir Divanji, founder at Neostrat Advisors, both experts in the financial arena. Thank you very much, gentlemen. So I'll come to what our sister concern Money Control is reporting in just a bit about a wider review and how you account for derivatives. But first, on IndusInd, Abhizir, massive, hit to sentiment, to confidence, really. And I think the market's entire issue was that if you knew this way back in October and you decided that there are some discrepancies and you need an external review, why didn't you disclose? Why didn't you tell the market? What are your thoughts on the way the whole saga played out and the CEO's explanation, which I'm sure you would have heard?
Yeah, so Surabhi, very frankly, why did it not come out earlier? I guess it's the bank would have best known why they did not do it. But very clearly, what would be also the case is that before you actually come to the markets, they would actually want to make sure that they know exactly, they've sized up the problem well and they've understood it well. That could have been a very big concern. And derivatives, frankly, as a accounting class or even as understanding what derivatives are about, actually is a very complex arena. So in my view, maybe the delay is because they were trying to size up what the issue was and whether it was prevalent, whether it was only a one-off incident, whatever. And as and when the bank would have got some level of comfort, they would have actually, come back to their investors. By the way, RBI would have obviously been informed much earlier. So it's not that the issue was completely hidden and within wraps within the bank. I'm sure consultations with the SSM would have been live as the issue would have been discovered.
But I guess delaying that disclosure to 5-6 months later, saying we'll tell the market when we have better clarity, that doesn't really help, right? It anyway damaged sentiment. It damaged, obviously, your market valuation as well, investor wealth as well. But, the bigger issue is understanding what is this accounting discrepancy. Let me bring in Karan as well. Abhizir, I'll come back to you because what Mr. Katpalia told us was that there is apparently this internal desk and there's an external desk, and one desk did not account for the loss and the other didn't account for the gain or something of that sort. Like you're saying, it's very complex. Karan, can you tell us a little more about the accounting methodology right now and what you understood out of this discrepancy that perhaps IndusInd in this specific case is speaking about?
So, what they've highlighted is that the internal desk or some part of their foreign currency borrowings, as well as, deposits that they had, and they held hedges against that, which were not disclosed earlier and have now been disclosed to the market. So that's where it stands at the moment. We are also having discussions with them where we will get to know about things in greater detail, but that's where it is at the moment.
Abhizir, come in on this internal desk, external desk, one not counting for the loss. I mean, it's at the end of the day, it's 2,000 crores. It's not like, 1-2 crores here and there. It's 2,000 crores we're talking about. How does this happen?
So let me explain what happens generic. Obviously, IndusInd, I am not part of the investigating agency, so I don't know. Yeah. But actually, I can tell you what happens normally in banks. So banks normally follow some kind of a siloed approach in everything. So they kind of distribute risk differently. So what they do is, there is an external deposit sourcing mechanism, which will source a deposit. Then they would designate it internally as a hedge. So they would say, okay, this is a hedge transaction. I'm going to hedge it. So internally, they would transfer it to the treasury desk internally by assigning certain, so they would do a swap. So
and this is a foreign, Abhizir, just to understand, and what we're talking about, this is an external deposit. It's a foreign currency deposit that a bank gets.
Yes, it's a foreign currency external deposit. That's the external leg from the deposit sourcing side. Then internally, they do a synthetic hedge to say that I will offer this to my treasury at this particular rate. And when they do the synthetic hedge, they record that hedge as a accrual accounting. So what it really does, it says, okay, the whole transaction is hedged. I am not exposed to any risk, either currency or interest rate risk. Right? So the deposit taking department is not exposed to the hedge. And what they then do is that they size up what is the loss, because clearly there is a loss. If you're sourcing a yen deposit which is cheaper, there'll be obviously a cost of acquiring that deposit. So that is accrual accounted over the period of the hedge. So it just says, okay, if my loss is 100 and the period is 10 years, I'll divide by 10 and I'll record 10, amortize 10 over 10 years.
So in
then
this case,
exposure,
synthetic...
this is synthetic, internal in the bank, internal in the bank. Then what happens is that the treasury desk takes that exposure on its books and tries to hedge it in the market.
Okay.
So they actually get hedges in the market. Now what happens is, the internal is based on certain benchmarks that they have devised, the bank has devised themselves. The external reality may be a little different. So actually there is no perfect hedge between what has been externally sourced and what is externally hedged.
Okay.
Now, because accrual accounting happens in the internal book and the mark to market happens in the external book.
Okay.
There is clearly a gap.
Okay.
Where as long as you're making money, there is no problem. But when you unwind that transaction, when a deposit gets prematurely withdrawn, for example, that is when the loss is highlighted, because the accrual accounting that is done internally doesn't match with the mark to market, which is done externally.
Mark to market. Got it. And that's
results in the larger loss.
Got it. Now we've understood, what the issue was. The question is whether this is just a, one-off, freak miss, or whether perhaps other banks are also missing these gaps, especially in times of high currency volatility. Karan, what's your sense on this? Because this seems to be a wider review that the RBI has now launched.
So, when incidents like this come to the fore, what RBI would do is it would initiate a kind of a thematic audit, whereby, they will go ahead and ask all banks to provide data to give them comfort that nothing of this, similar has been left out in terms of disclosures to the market. I think that's the way this is progressing at the moment. And RBI is likely to reach out to other banks as well and get those get that data in place.
Abhizir, what's your sense? I mean, you've seen the sector for decades. Could there be risks of other such gaps or forgotten loss declarations showing up in other banks as well? Or could this be just a one institution-specific incident?
So from an accounting and reporting perspective, I can tell you derivatives is the least understood. by the regulator as well as the market, very frankly. So in my view, could there be other issues that may come up in other banks as well as this bank? It's quite possible. Because the RBI came out in the 2024 circular precisely because of the gap that they identified. And they said that, listen, this is not working because the internal transfer pricing is not matching with the external hedge. And hence they said that you cannot have any open positions at all and you need to hedge everything in the market. When the circular came out, even IndusInd started investigating their books. So ideally, when every bank will start investigating their books, they may find these gaps. How large those gaps are will clearly depend on positions taken by the respective banks. But I think now there is going to be a lot more awareness of how treasuries function. So, I worked in a treasury before, and really what the rule, especially in foreign banks, is in their international operations, is that you simply go and hedge everything back to back. That's it. Don't worry about an internal book or an external book. You simply go and hedge every exposure that the bank is taking.
And wherever there's a loss, let it clearly show up and communicate. Yeah, communicate it to the to the
if it's an equal
right?
and opposite between the internal and external book, the loss will get recognized and the gain will get recognized.
Okay.
I think that is how. So RBI will clearly want this to be investigated. I don't know whether RBI will have the skill sets to do it, but very clearly there is a skill set gap in the market itself to assess how this is to be done.
Oh, okay. Karan, now in light of these fresh developments and what both you gentlemen are saying, that this could be evident maybe in other banks as well, because now the review is on. So now we'll figure out, where the gaps are and what's going on. Does this open up a brand new regulatory risk? The market thought it's all fine. I mean, we were completely okay from a liquidity standpoint, from a rate standpoint, rate cuts happening, asset quality was fine. There was nothing else in terms of a fresh risk. Is this one now for the financial sector?
So see, when we are talking about banks, right, the narrative around the sector has completely changed over the last few years. We are no longer in a position where we are complaining about, the sector being in need of capital or the asset quality being under pressure, or even the profitability, not being up to the mark. So this, at the moment, has to be taken as a one-off. We'll have to wait to see what the review brings out in terms of if other banks are also going to be impacted by this. But at the moment, I don't think one needs to paint the whole sector with the same brush. That's where I would leave it.
Abhizir, your thoughts? Investors these days in a falling market, everybody will come and tell you, go buy banks. Everything's fine there. But now, what about this? What would your advice be?
I don't think the banking sector is at risk, nor are banks at risk, including the one.
No, not at risk. I didn't mean at risk. I'm just saying a new unknown, and the market always dislikes new unknowns, unpredicted.
So really what's happened is, and I think I agree with Karan, that this risk is something that will have to be measured, and I don't think it may be all pervasive in banks. But what is happening is the external environment is changing aggressively. As countries turn protectionist and as tariffs happen and those kind of things are happening, you will find exchange rate volatility to be there, interest rate volatility to be there. And the banks will have to learn to manage them more dynamically than they would otherwise be doing. So clearly that will result in a new risk in terms of the banking sector, because until now exchange rates have been moving north, may not necessarily happen going forward.
No, got it. So this is...
It has to be controlled.
Absolutely. And this is a new X factor, so to speak, that's kind of crept up. Just a final word, with Vishal as well. With Karan as well. Karan, X of this issue, which is a completely new one, just leave us with your broad forecast in terms of credit uptake, in terms of the peak of the asset quality stress, credit costs as we are entering FY26. Just remind us of your overall projections.
So in terms of the overall projections for the banking system, we are forecasting about 13.5% year-over-year loan growth for FY26, and deposit growth also should be in the region of about 12.5, which means that the gap that one was seeing over the last few years between credit and deposit growth, which led to the LDRs increasing, that is going to get minimized over the near future. However, the picture for NBFCs is slightly different. Therein, we are more mindful about the credit cost increasing because of certain asset quality pressures that we've been seeing in asset classes like unsecured business loans, MFIs, and to some extent, even personal loans as well.
Okay. All right, Karan and Abhizar, thank you very much. Very helpful perspective. And I think at the end of this conversation, what we do know is that investors need to strap up for maybe some more uncertainty on this whole derivative issue. It might not be restricted to just IndusInd Bank alone. Let's see what the next couple of weeks and months bring. Well, with that, folks, back to the markets.
Well, that's right. Let's focus on a couple of names then, a couple of stocks on the move. Sudarshan's here to tell us about Muthoot Finance. Sudarshan, stock is under pressure. There's something on the BSE, right? Tell us more.
So Muthoot Finance had yesterday disclosed to exchanges regarding a fraud. That fraud amount is very small. It's of rupees 12 crore, but nevertheless, it's a fraud. And that's the reason you're seeing a downtick in trade. Currently, it's down almost more than 1%. At one point, it was down more than 2%. And it was informed by Muthoot Insurance Brokers that fraud was done by its CEO of Muthoot Insurance Broker, an ex-employee of Muthoot Finance. And now this fraud is related to the gift rewards that basically these people receive from insurance companies, and it was done in the period April 2023 to November 2024. So despite the amount being less and company Muthoot Finance saying that there is no financial impact, you are seeing a downtick in Muthoot Finance stock.
Indeed, it's not the amount, but the move that it is causing the worry out there. But just keep an eye on a couple of other stocks as well. BB Fintech, after a big drubbing that it saw yesterday, is down about 4.5% today as well. Opened mildly in the green, and that was quickly sold into the stock, down about 5.5% from today's highs. So from yesterday, the stock has seen a correction of almost 7-8%. And the reason why that has happened is because the company is allocating funds towards getting into the healthcare space. The street believes that maybe this could be, there could be better use of that capital, though we did speak with Nilesh Shah, and he believes that there is no case of misallocation of capital. Where this settles is something that we'll keep an eye out on. And we continue to see weakness in the cement names as well, particularly the south ones. But let's get in Mitesh Thakkar now. Mitesh, your trade's at 10?
Yeah. So good morning again. I think the market has been very subdued and quiet, but still looking at, some kind of positive traction, at least on the Adani Group stocks. That's where I think these stocks are doing well. So we would recommend a buy on ATGL. I think that's transmission and gas stock. Buy here with a stop at about 600 for targets of 645 to begin with, and eventually hope that, we might get higher levels. And on the second stock, which I have, is a sell on Axis Bank with a stop at about 1022 for targets of 980.
Okay, all right. Got that. Thanks a lot, Mitesh, for that. Well, let's focus on an inward-facing sector or the economic-facing sector. That's the cement space. Yesterday, we had the Tamil Nadu government that had imposed royalty on mined limestone, which made the street a little bit nervous on a couple of names. But JK Lakshmi Cement, well, that's the stock on our radar. We want to ask them, how is demand shaping up and what's the path ahead? Well, to help us out with that, we have Mr. Arun Shukla, the President and Director at JK Lakshmi Cement. Hi, Mr. Shukla. Good morning and thanks a lot for joining in. Well, there's a brokerage positive note as well coming from HDFC Securities. But before we get to those points, let's talk about the industry first. Is demand as strong as expected? We understand that the government is spending more. That's reflected in demand on ground. And what about the real estate space? Housing sector demand is as strong as expected?
I think demand is improving after quarter two being very sluggish. Quarter two onward, quarter three onwards, things have improving. And quarter four has been very good. I think this is as per the expected demand level. And of course, I think all those, budgetary allocation in infrastructure segment and even income tax relaxation to middle class, that is helping us to drive demand at the ground.
Okay, so quarter four is good. So for if you compare quarter four with quarter four of last year, what's the growth like? Because it'll be on a higher base. That, it was before elections. There was a lot of money being pumped in. So what kind of growth for your company can you do quarter four versus quarter four last year?
So January, March typically is high. You are right that base is high, hence growth is going to be about industry growth 7 to 8% in quarter four, and we are going to grow in alignment with the industry.
Got it. Great. HDFC Securities, they have pointed out in a note that for this year, it will be a very flattish number for you in terms of volume growth. But they are saying the next 2 years, you will grow by at least 9%. You concur?
Yeah. So I think if you look at, industry overall is going to grow at a rate of about 4.5-5% this year, right? And we are going to grow at about, let's say about 3.5%, which is more or less in alignment with the industry, because industry has also not done so well. Now, going forward, yes, we do have a very, strong conviction that we are going to grow at a rate of, 9% plus, which is going to be little higher than the industry growth in coming years. And more so because, the kind of, growth plan which we have set up for ourselves, that is going to drive volume and, of course, top line for JK Electronics.
Okay, so this year maybe you'll grow in line to a little lower than the industry, but the next year you're confident that you'll outgrow. So 9% volume growth, we got that out of the way. Tell us about pricing, Mr. Shukla. What's happening there? That's been the biggest problem, right? Many times you're increasing prices, the street is not accepting it, your demand is fairly good, but still the buyers are not accepting it. If I compare pricing on an average for Q4 in comparison to Q3, what is the change? And also, if you could help us out with your premium segment as a percentage of your sales, what is it?
Yeah, so coming to prices, I think, prices have not been good this year, and that started from Q2 this year because of sluggish demand. Now, since demand is improving, I hope that prices are also going to enhance in alignment with that. And definitely, I think Q4 is going to be a little better than Q3 in terms of pricing. My estimation is industry, pricing growth or the realization improvement would be about 1.5% per share. And I think JK Lakshmi also is going to be in alignment with that. So this is, I think, part one of your question, right? And second, we talked about premium. Yes, I think perhaps I'm really happy to let you know that we are one of the companies where premium segment is doing very well. Our premium segment out of our total trade sale is about 25%. And our plan is to take it to 30% going forward. We have been doing quite well in premium segment, and going forward also, I think we are hopeful that our, the kind of product and value proposition we have, we are going to grow better than all other peer groups.
Okay, two numbers, sir, if you can give us. You'll have an ambitious plan that you're going to be taking your capacity from around this 20 to around 30 million tons, and you'll have that on the drawing board by 2030. So in the near term first, EBITDA for this year will be in the vicinity of around 600 to around 700 rupees, maybe around 650 on an average for the full year. But you have a note coming in from a brokerage like HDFC Securities. They are saying that that number is going to go up by around 200 rupees. So for FY26, FY27, you should be in the vicinity of around 850 to 950 rupees. Do you agree that EBITDA per ton will improve by around 200 rupees in the next year in comparison to this year? Point number one. Point number two is, expanding is great. What about net debt?
Yeah, so coming to your first point, yes, EBITDA, I think we have been doing quite a bit around this, efficiency improvement with manufacturing costs. We are one of the best, cement cost producer in India. We have been working on supply chain efficiency using digital and technology, which we have been doing for the last more than 1 year now. And also we have been working on, top line efficiency, like premium product we talked about. We are also working on, improving our price positioning. Just to let you know, in the recent past, just about 2 months back, we have launched our, green product called, JK Lakshmi Green Plus Cement. This is, towards our, effort to enhance our price.
Yes, Mr. Shukla, we have that release. That's a good initiative, and as you said, demand is fairly good out there. EBITDA number improves by 200 rupees in the next year in comparison to this year?
That's what I was coming to, your question. Like, all those initiatives on manufacturing costs, on supply chain, on top line, and, renewable energy, this is all definitely going to take us our EBITDA upwards towards, 200 to 250 rupees for sure.
Okay, all right. Well, a little bit short on time, sir, but thanks a lot for joining and giving us those details. And for the time being, you don't have exposure to Tamil Nadu, so you're saved from this, this royalty hike, but we'll have to see whether other states implement that as well. Thanks a lot for joining in. Well, for the time being, slip into a short break. Come back. Manish Gupta will be joining in to focus on the commodity space. Stay tuned.
Markets picked up pace now. 22,540 is where the Nifty is at, and it's being led by a couple of these FMCG names. So Britannia has moved to the high point of trade. We're seeing some traction in ITC as well. And at the same time, we saw some purchase in names like Titan and Divi's Lab too. Speaking about Titan, speaking about gold, speaking about silver, let's go across to Manisha, who joins in with all things commodities. Manisha.
Thank you for that. When you look at the overnight markets, we saw gold gain, we saw silver prices gain, and we saw most of the metal prices gain quite strongly as well. Well, to begin with, it is about the US dollar index, which is trading at a 5-month lows, which clearly has been supportive. And as you can see on the screen, we're trading at multi-month highs for many of them. The best of the gains clearly continuing for copper and aluminum, where we are trading near 9-month highs. And then you have zinc at 2-month highs, 13-week highs on lead, 1-month highs on steel, and a couple of month highs is how the iron ore prices also are trading with. It all has to mostly do with tariffs, where we have seen 25% of tariffs now on all US imports of steel and aluminum. And that tells you on how much US really imports. So all the trading partners or allies, that is, the numbers are quite huge when it comes to the neighboring allies for US there. So when you look at Canada, 23% of imports that US does in sense of steel comes in from Canada, 16% from Brazil, and then Mexico is quite an interesting ally there as well. And I have a similar chart when it comes to aluminum as well, where you will see that much of those imports that US does come in from Canada. 58% of overall imports do come in from there. Well, interestingly, when it comes to China, which is going to be an important number to watch out for, while we already have 20% of tariffs on China, add to that more 25% as well. And many of these metals could actually be looking at 45% of import tariffs when it comes to steel and aluminum. I want to move on and talk also about metal prices, and that is the most interesting of charts really, because there are two major markets that you follow when you're looking at metals. One is China, London, and then it is about US. And when you look at all of those prices, you will see that the US metal prices have surged way more higher than what the metals really have done in London and China. So when you have the copper prices, they've gained 10% on LME, but they are up 21% in the US markets there. Aluminum has gained 6% on LME, but is up 15% in the US markets. And steel, these are the Chinese prices. They are down 2.5% in China, but we have seen 31% of increase in steel prices in the US markets in this year until now. So as you can see, there is big disparity in the international markets when it comes to the metal prices.
All right, Manisha, thank you so much for that. And finally, let's talk about some other movers as well. We are seeing some traction in the markets, but what we'll do is actually take this short break, come back on the other side. We have Lata joining in with a special Indianomics segment where she will be in conversation with the former RBI Governor D. Subbarao to talk about inflation data, the Trump tariff impact, and all things macro.
Hello and welcome to a very special edition of Indianomics. Things seem to be falling in place in the Indian economy. The February inflation was lower than even the MPC target, given target of 4%. And on the other hand, the industrial output number for January has come in at 5%. Given that the April-January number is only 4.2, this definitely looks like a breakout number. So inflation lower than expected, growth higher than expected. But will our economy, its recovery, be blunted by the kind of globe in which we are sitting? Just this week itself, countries across the Atlantic Ocean, which have been friends for over a century, are imposing tit-for-tat tariffs on one another. Europe on the US and US on the Europe. And likewise, there are tit-for-tat tariffs between US and Canada as well. And the other surprising factor, therefore, is that the US economy may go into stagflation or recession, but Europe is emerging as a surprising area of growth because after 3 decades, Europe and Germany have decided to increase their fiscal deficit by 1%. Now, it's clearly a rudely disturbed world, and we need the advice of an expert. So today, my guest is the veteran policymaker from India, former Reserve Bank of India Governor, Dr. Subba Rao. Dr. Subba Rao, thank you very much indeed for finding time for me for the show.
Thank you.
Well, first up, let me start with the immediate Indian economy numbers. Inflation coming lower than expected. Industrial growth finally seems to be breaking out of the low single digits. Do you think we are on a path to recovery from that slowdown we saw in the second quarter?
It's good to start on a positive note, Lata, and I knew that that's got to be a headline question.
Okay.
I saw the inflation number which came last evening, 3.6%, which is comfortably within the inflation target. And also, as you mentioned, industrial production has improved. Growth. On the other hand, there's concerns about growth, and I believe the rupee has adjusted for the time being. So I believe, I'm a bit wary about commenting on the RBI's policy options, but I believe there is quite a good scope for further easing. But what I want to say is this, that monetary policy has only limited potential to push up growth, because monetary policy can push up growth to the potential level. But pushing up the potential level of growth itself is the responsibility of the government, responsibility of fiscal policy and development policy. So we've got to understand that. Yes, as much as there is an opportunity for the Reserve Bank to ease further, we've got to understand the limitations of monetary policy in raising growth beyond the potential growth rate.
Oh, yes, that's an important lesson you're telling us, that the Reserve Bank can move within the potential that the fiscal policy, the economic policy sets. But do you think we are in a cyclical slowdown only, or is there something structural that we are unable to break out above the 7%?
Well, I've studied all the people who've weighed in on this issue, and that there is opinion on both sides. There's some people who say it's cyclical, some people who are more cynical say structural. Those who say cyclical say that, there is a global headwind, there is a tariff war, there is a trade war, there is geopolitical tensions. Domestically at home, the Reserve Bank was on a tightening stance. There's fiscal consolidation. Therefore, the growth to some extent is constrained. But over the last 3 years, the government has spent an enormous amount on public infrastructure. That's going to crowd in private investment now. Moreover, the budget has given a boost to consumption. That too will add. Therefore, good times will come. This is just a cyclical blip. We will be back to a high growth trajectory. That's the cyclical view. But on the other hand, there are structuralists who argue that our catch-up growth potential has been exhausted. In fact, if you go back to pre-COVID time, growth was actually slowing. 2017, 18, 19, 20, growth was slowing from 7%, 6%, 5% to 4%. Yes. The rapid growth we saw over the last few years is actually a rebound from the COVID blip. There was revenge consumption. Okay. Afterwards, the government took over and spent on public investment. But those drivers are now exhausted. The question these people ask is, where are the growth drivers? The economy grew at 8% last year, 8.2%, but consumption grew at less than 4%.
Yeah.
So if consumption does not grow, can we maintain a high growth rate? Private investment, just about 25% of GDP in 2008, is today about 12 to 13%. Net exports, the situation is bleak. It's a leap of faith to believe that the global situation will improve dramatically in the next few months or even few years. And the government's ability to spend is limited. So where is the growth driver is the question the structuralist asked. My view is that our growth slowdown is partly structural and largely cyclical.
Okay, so you would blame the Reserve Bank for being a little too tight with its liquidity last year?
Well, I wouldn't blame them in that sense because I believe the Reserve Bank was enjoined to maintain a tight policy. After all, inflation was above the target for a considerable period of time. So they had to keep interest rate high, as also run a tight liquidity regime. There is some sacrifice of growth because after all, the objective of tightening is to choke demand. And when demand is choked, there is some constraint on growth. To some extent, growth is compromised. But that is only in the short term. In the medium to long term, I believe low and steady inflation is a necessary condition for growth. So I think it's unfair to blame the Reserve Bank of India.
Yes, to be fair, they smelt the problem in the unsecured loans earlier than anyone and raised risk weights. And even today, they've maintained those risk weights for all the other loosening. But let me come to the big question, really, the one that is confronting us globally. What is your take now? Where are we headed with President Trump announcing reciprocal tariffs? Is April going to be a terrible month for us?
Well, I cannot give an expert view. There's too many things happening. He slapped tariffs on Canada and Mexico, deferred them, and slapped tariffs in China. China has retaliated. He's slapped tariffs on aluminum and steel, and threatened tariffs on dozens of countries, including India. So there's just too many moving parts, and it's difficult at this time to decide where this is going. But one thing is for certain, this is not going to be a painless option for America, because tariff increases are going to raise inflation in America, and there's going to be pain there. Moreover, the ostensible objective of Trump's tariffs is to reshore manufacturing to America, generate jobs there, and reduce current account deficit. Actually, it's not clear that these objectives will be realized. In fact, what might happen is maybe the opposite. For example, if there is already talk about tariffs raising the cost of manufacturing in America, particularly cars. Some car companies are contemplating cutting down production. So jobs will be lost, and imports might actually increase, raising the current account deficit. So there is going to be a backlash because of inflation, because of job losses, because of high current account deficit. To what extent can Trump countenance this backlash will determine how we go forward. About India, we've got to recognize that America is our largest trading partner, and one of the few countries with which we have a trade surplus. Of course, it's threatened us with reciprocal tariffs. There is called us the tariff king, actually.
Yes.
And we made a lot of concessions over the last few months during the budget, before the PM's visit to Washington, during his meeting with President Trump. Even after he came back, we agreed to import more defense, more energy, reduce our trade surplus with America. And there's talk about an FTA, but an FTA is not going to be all that easy. There is the very critical issue of agriculture affecting millions of livelihoods. And it's also not clear to what extent they will raise non-tariff barriers. But assuming or expecting that we will have a reasonably good FTA by September, as the government is assuring us, the best option for India, or best scenario for India, would be that we have an FTA with America, and it slaps tariffs on China and other countries. then we'll have a window of opportunity for trade diversion, for example, as happened during Trump's first term. We got a lot of trade diverted to us because of tariffs on China. So that's the first opportunity. And a more lasting opportunity will be the China plus one option, that India might become the plus one. But this is conditional, again, on a reasonably good FTA and we getting our act together. Both are two big Fs.
Okay, I agree with you, sir. We should know about the FTA sooner, but getting our act together, of course, is going to be a long-standing effort. But, you know, as an economist and a central banker, I just wanted to clarify one seeming contradiction in what President Trump wants. On the one hand, he wants lower current account deficit. That's what he's arguing with everyone. But on the other hand, he gets, I mean, he wielded a stick even at the BRICS countries because we want to move away from the dollar. Now, you can have dollar as the global currency only if the US has deficit, because they will print dollars to bridge the deficit. These are contradictory goals. How will they play out?
Yeah, that's an important contradiction you're pointing out, a good point, actually. You know, the reality is that the dollar is the world's dominant reserve currency. Much of international trade and finance is conducted in dollar. And significantly more than half of central bank reserves are held in dollars. So in order for this to happen, there's got to be sufficient dollar liquidity in the global system. Yes. And for that to happen, America has to run a current account deficit. So to simultaneously expect the current account deficit to come down and to maintain dollar hegemony is a contradiction. But I want to also point out that it's not as if America is doing the world a favor by running a current account deficit, as actually you know, the president, who said that America is actually enjoying an exorbitant privilege. Because, you know, the world, got a dollar's dominant position in the global system. Yes. The world is willing to lend to America, and America is able to live beyond its means. Yes. For example, if you or I have $500 in our pocket, you know, we are actually giving $500 of interest-free loan to America. Yes. And America is borrowing billions and billions of dollars every year and living beyond its means. Yes. So it's not as if America is doing the world a favor. So, and if, you know, like you said, is threatened tariffs on BRICS countries. Now, the point is, the dollar is not anointed as the world's reserve currency by an international agreement. It is the reserve currency because of the virtue of America's strong economy, its liquid and deep markets, its resilient and mature institutions which inspire confidence. So if BRICS countries, or indeed any other country, find that moving out of the dollar is less costly than staying with the dollar, they will move on, because there is no compulsion to stay with the dollar, and I don't believe how Trump can force that to happen.
Yes. You know, so many of our well-known or used to principles are getting thrown up. We don't know when the dollar also will start challenging us or, you know, move out of our daily lives. But let me come to the rupee itself now, coming back to India. We saw this sharp deceleration of the rupee. Would you blame it on the Reserve Bank? I mean, the Reserve Bank was accused of keeping the currency too stable.
Blaming is a strong word, but let's see what happened over the last 2 years. You know, America's growth was resilient, the dollar was getting strong. Consequently, the rupee should have depreciated. RBI should have allowed it to depreciate. Instead, they mounted defense, intervened in the foreign exchange market, maintained the rupee stable at a time when the rupee was actually overvalued in real terms. But over the last 3-4 months, the Reserve Bank has allowed the pressure to ease. So the rupee is now, I believe, finding its market level. But the more important point is, I think the Reserve Bank is institutionally more prone to intervention than is warranted. Okay. You know, we want to be, if you try to defend the exchange rate against fundamentals, there's a cost to be paid. Cost not just in terms of keeping reserves and using them, cost of distorting markets. You know, we want to be a developed country, we want to be a mature economy. If we want to be there, our market participants should be used to adjust to two-way movement of the exchange rate. If the Reserve Bank is seen to be intervening every time the exchange rate moves, they will never learn. In fact, they will outsource the risk management to the RBI, and the cost will be paid by the entire economy for the benefit of a few.
Fair point.
I agree that the Reserve Bank has to manage excess volatility, however that is defined.
Okay.
But not defend the exchange rate against fundamentals. Should not prevent the movement of the rupee, but engineer the trajectory of the rupee. That's what I would say.
Okay. Well, I want to discuss more about the rupee depreciation, especially because this time it's because of the capital account. But that will be after a commercial break. For Bazaar viewers, it will be time for Chartbusters, but you will get to hear the entire chat with Dr. Subbarao after market hours.
BEL climbs more than 2.5% after the company bags a near 2,500 crore rupee order. It takes the total order inflow in the fourth quarter to 7,200 crore rupees.
Adani Green trades more than 3% higher after the brokerage firm Macquarie initiates coverage on the stock with an outperform rating, target price of 1,200 rupees. It expects the company to lead India's energy transition and generate near $2 billion of annual cash flow.
MTNL rallies over 14% as the company received nearly 13,000 crore from the sale of assets of the company and those of BSNL.
Gensol Engineering slips ahead of its board meeting to raise funds and discuss a stock split as the company looks to support its balance sheet.
Shares of PB Fintech continue to decline. The stock is down another 4% after a similar fall yesterday. The company, remember, had announced a near 700 crore rupee investment in its healthcare arm.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Mangalam. And as you can see, the top of our screen, well, there's going to be green that's coming up for you. The Nifty is at the high point of the day. The breadth of the market is pretty good and the Nifty Bank as well.